Thanks for joining David, Kevin, Alex, and myself for the market update for the month of February. Hope you and your families are doing well. February brought us a little bit of a mixed market. The Canadian market was super strong. It was up 7.57%, measured by the S&P TSX Composite Index. The US was off a little bit, minus 0.87%, measured by the S&P 500. And the MSCI EFI, the European and Asian Pacific markets, were strong as well. They were up 4.5%. I'm going to pass you over to the guys, and they're going to take a little bit of a deeper dive into that. But as always, please don't hesitate to call us if you need anything. Take care and hope you and the family are doing well.
Thanks, Harry. So what we saw driving global markets in the month of February was kind of a rotation out of the growth and high valuation technology names, with value and cyclical sectors outperforming them. A trend reflected in Canada's strong materials and energy sectors versus the US tech weakness throughout the month. On the macro side, we're still seeing an accommodative central bank policy both in Canada and the United States, and combine that with solid economic data underpinning investor confidence throughout the month. Inflation continues to trend closer to the target ranges in both countries, although it's still remaining sticky in some areas. Ongoing global demand for energy and industrial metals help bolster commodity prices, really benefiting Canada's resource-intensive markets.
Now, looking forward as we move into 2026 here, we think that earning trends and interest rate decisions really remain crucial drivers of the economy. Another factor is global geopolitical and macro developments. Now, these are going to continue to influence risk assets and safe haven flows. Now that we've covered February, obviously a lot has changed in recent days as we sit here filming this market update today on March 3rd. The US bombed Iran on February 28th, killing the head of state in Iran, Supreme Leader Ali Khamenei, over the weekend. Now, markets managed relatively well on Monday. After a weak start to the first trading day since the hostilities broke out, North American markets actually ended up finishing in the green. Oil was up, as were safe haven assets, which include gold and the US dollar. However, today, Tuesday, March 3rd, has been much weaker, with everything down from overseas markets to bonds to gold to North American equities.
So we've seen a lot of people asking, why did yesterday start out so well, even though this conflict really started over the weekend and the market impact really got delayed until today, which is Tuesday. And really, we think that boils down to the fact that this is not really a surprise. Tensions had been growing in the region over the past few weeks and months. There's military assets had been staging and growing in the area for the last little bit. And on top of that, you have a US administration which is much more inclined to use its military force than we've seen previously. And really, with all those factors, the surprise would have been if nothing happened. Now, markets generally move when there is a surprise. Now, perhaps Iran's retaliation on some of its neighbors is a bit of a surprise, or a few signs that the conflict is spreading. More US casualties would have been a negative surprise, as would the targeting of energy infrastructure, which is possibly starting to show up now. The magnitude of this is clearly greater than the brief bombing of nuclear development sites that we saw last year, or the Iran-Israeli missile exchanges in April of 2024, but so far, not many surprises. Obviously, that can change. It's in the name. That's why they're called surprises.
So something we hear a lot is that the market remembers, and with short-term memory being much more dominant than the long-term memory. Putting boots on the ground leads to much longer and more painful and drawn-out market reactions. However, dropping bombs can end just as quickly as it started. The following chart shows the past 5 times Iran has been bombed and the path of oil prices in those periods. Now, the turquoise line that you can see is the current situation this year. It's already off to a bigger start than past episodes. The general trend is for a spike, then the oil prices gradually come back down. It's a very different chart if you go back in time to when boots were put on the ground, and we'll show that in this next set of charts here. Generally, when boots do go on the ground, we often see a doubling of oil prices, and it can be much more prolonged. So one of the main reasons that energy markets might endure this type of supply disruption is because of the global supply versus the demand of oil currently. Right now, we're looking at a surplus of about 2 million barrels a day, and that certainly makes managing a temporary supply shock or disruption like this much easier.
So at the end of the day, we don't know how this conflict is going to play out. It could be drawn out over many months, or it could be over in a week. We really don't know. The longer it does go on, the higher the probability of a risk-off event, which may be a buying opportunity given the solid economic backdrops in developed markets like North America, Europe, and Asia. Long-term investors should remain focused on diversification and disciplined strategy given geopolitical risks and mixed leadership across major indices. As always, if you do have any questions about the markets or how that affects your individual portfolio, please feel free to give us a call. Harry, David, Alex, or myself are happy to chat with you anytime.